Welcome to Mortgage Coffee Talk on Awaz Television. I'm your host, Tahir Qureshi. Tonight, we will be talking about consequences of mortgage defaults. My panelists are Taimoor Qureshi, is a lawyer, and also Wes Sudsbury is a mortgage broker and also president of Canadian Mortgage Broker Association. So welcome you to
Hello.
our coffee talk.
Thanks for having me.
We're gonna begin our program to ask Taimoor Qureshi to introduce yourself for 1 minute, and then we're gonna ask Wes to introduce himself. Then we'll start the discussion. So Taimoor.
Hello, everyone. Tahir, thank you for hosting us today for this forum. Interesting topic with everything that is going on. As Tahir said, I'm a lawyer. I practice with a law firm, Corman's LLP. We are primarily located at Mississauga, right off 403 in Ontario. That is our head office. We also have an office located in Markham and then another office in York region. Primarily, we focus on real estate from all facets. Purchase, sale, refinances. We represent lenders, borrowers on private mortgages, institutional mortgages on both ends. And then we also focus on corporate and commercial matters.
Okay.
So Tahir, thank you for hosting, and I'm looking forward to discussing this wonderful topic today.
Okay, Wes, go ahead.
Yeah, thanks Tahir for having us. I'm Wes Sudsbury, mortgage broker with HomeGuard Funding in Newmarket, Ontario. We've got offices spread out across Ontario. We serve borrowers, investors, lenders, arranging in mortgages, private mortgages, institutional mortgages, based on whatever the client's needs are.
Well, thank you very much for introduction. The issue is consequences of mortgage defaults. When we talk about the mortgage defaults in consumer perspective, it is that when a borrower failed to make the payment to the lender, or his ability is jeopardized, he lost a job, or whatever consequences are. So the issue comes to you is something in a legal point of view, because in Canada, we use power of sale versus a foreclosure. There are two systems. Mostly, some provinces, they do apply the foreclosures, but most of them are power of sales. So the question I have for you is that we're going to talk about multiple point of view. So first thing that comes to your mind, Taimoor, is when somebody say, I am a default, I'm not making to make payment. Do they approach you at that time, or they're already in the process when they approach you, and what steps that they have to do to redeem themselves, because power of sale would allow them to redeem themselves if they're able to come up with the money or alternate funding?
So the step for power of sale works like this. If you have been in default for 15 days,
yes,
then the lender reserves the right to send you what is called a notice of sale. Okay. So that notice of sale is the official start of the power of sale procedure. Before that, now this is at the lender's discretion. If they wish, they can send you a demand letter before that. But let's say they have issued the notice of sale. Now the borrower has 35 days to make good on that default. Up until that 35-day time period, the lender cannot take any further action to either evict or take power of sale procedure beyond that step. If the borrower is able to make good in those 35 days, then they're back to square one. If not, then the lender can apply for what's called a statement of claim and then get an order for writ of possession. That allows them to take possession of the property and then put the market back on the market to sell the property through power of sale.
Yeah, we're going to go to that process. The first thing that comes to you as a mortgage, when Wes comes, somebody says, I am a default.
Mm-hmm.
When Wes will talk about the cost to your credit, could you tell us if somebody goes to in a power of sale, or before power of sale, they default on payment of the mortgage.
Right.
Because coronavirus is affecting them, they are deferred payment, and they're going to accumulate at the end because they're going to they have to pay that. So if somebody is even deferred payment, is sometime is going to accumulate or
Yeah.
extend the period of time. The issue that I have is that if they default, how much effect it will have on the credibility. So there's a Wes, can you explain us cost to the credit of a borrower?
Well, typically, if you're going through, if you have missed a payment on your mortgage, it will show on your credit bureau that that payment is late. So that's number one. So if you are over 15 days past due, you're going to get what's called an M2, and that's going to report on your credit bureau. If you're in that situation, that's going to seriously impact your beacon score, your credit score, which lenders look at to approve you for financing. It will also, it sets a lot of red flags when we're applying for a new mortgage when the existing mortgage is in default. So typically, we look at trying to remedy that the missing payment and bring that up to date before we do anything. If we can't, then we've got to look at alternatives. But that M2 that's on your credit bureau, missed payment, that will be on there for 6 years. Even if you just miss one payment, it'll show and report there for a period of 6 years.
So in this case, just to continue, and before I go back to Taimoor, is that when we are doing deferral payment, this is with the consent of the bank is being delayed. So they are not treated as default payment, correct?
It depends on how the lender is reporting that, but I believe most administration centers, when you're applying for deferrals, they trick their system to show that the mortgage is not in arrears.
Yes.
So typically those won't show. However, if they do, there is some safeguards provided by the credit bureau agencies, Equifax and TransUnion, to report on anomalies during a time of crisis such as that we're in. Yeah. So there are mechanisms in the algorithms to reduce the burden that if there is an error in reporting. And always there's the story behind everything. So if that was showing and we know that it was a deferred payment, we can always get something in writing from the lender to explain that and provide that to the new lender that we're applying to show that it was not the default of the borrower. They were proactive in that situation. And most lenders will look at that as a good credit-worthy person who's trying to be proactive to be communicative with their lender.
Fantastic. Now, in this situation, when you have in a power of sale situation, if the borrower is not able to rectify, the choice they have is to speak to the mortgage broker like you and me and talk with them and see if we can do alternate funding to somehow mitigate the problem and restore their status with the lender. Sometimes the lender have a history and they say, no, we're not going to do it, then you might have to pay out or the whole amount or make a refinancing arrangement. So now can you, Taimoor, share with us any situation where you might have dealt with something that happened in this situation where you were helping them to mitigate the losses before they put their property in the market for sale?
So it has to. We have to be, as a lender's representative, right? You have to be very careful. Once the power of sale procedure has started, right? Yes. You cannot take partial payment because even if you take $1, it resets the entire timeline. So, right, even if you take $1, it resets the entire timeline. Yeah, so the negotiation between the borrower and the lenders have to take place before the power of sale procedure has started. Because then now, once the power of sale procedure has started, the lender has spent enough resources and money on it that for them to take partial payments, is a disadvantage to them. So it's very key that the parties negotiate before the power of sale procedure has been started. Now, when I'm acting for a borrower and I'm getting lots of feedback on these issues these days, especially for private mortgages, where people are being proactive. That's the number one key. You have to be proactive. You have to give advance notice to your lender saying, listen, my next payment, my next post-dated check, please do not cash it. There won't be enough funds, and I don't want a default. Can we work something out? Do not wait until you get an NSF notice from the lender, because then they have the right to pursue legal actions. So my best advice to all borrowers is take the proactive approach, like Wes mentioned. Look in advance. Are you going to be able to make the next payment or not? If not, let your lender know right away. Let your mortgage like Wes, or if it's a private loan that you did through a lawyer like myself, get in touch with us right away so that a proactive approach can be taken right from the get-go, rather than digging yourself out of a hole that's too late to dig out of.
Yeah, Wes, as you know that those people who have conventional mortgages, they have quite a bit of equity unless they have used their line of credit, which is go parallel with your mortgage and equity line. They've withdrawn too much money and there's nothing left there for them to hold on to it. And mostly people who have a built-in 20% or more equity, they have a safe margin there to survive, or if they have not used a home equity line, they should establish one equity line to pay for the mortgage until they get back to the normal. Is that something that you would recommend if nobody has a equity line, or reconsolidate all their debts? Because all of us, we have this plastic card, it's called, Visa card and all, TD card, whatever, and we use it. It's so convenient. And then end of the day, especially in Christmas time or other holidays, we spend so much money to buy gift, to get sentimental, send everybody gift, and the bills start coming in, we have no way to paying it, or job is lost. In this situation, we have a coronavirus. So debt consolidation become a big challenge, and they need to proactively pursue that before they reach a point of no return, which is defaulting on your mortgage.
Yeah, the general rule of thumb is and probably the key word for this session is being proactive. And if you don't have a contingency fund set up, or a line of credit situation as a backup plan, you need some kind of backup plan. So if you have no backup plan and you have no resources for that backup plan today, it is a good opportunity to speak with a mortgage professional, speak with your bank, speak with a mortgage broker to get something set up for you. In the event that you do, it's always easier to get credit when you don't need it. So being proactive and setting these things up ahead of time is a lot better than missing a payment and getting an NSF and then calling your mortgage broker to remedy it. You're going to get much cheaper pricing, and if you are in a situation, eventually you can also, if you have that safety net, you could talk to your real estate agent and say, I've lost my job, I can no longer afford my house, I've got 3-4 months, sell my house. Because you want to be in control of the sale. You don't want to wait for your lender to sell the house.
That's absolutely true. Now, the conventional mortgages, unless really somebody is taking a very big jump and get a bigger house, a very heavy mortgage, and they lost their job and the government support and everything, it doesn't support them, and their lifestyle is so lavish that they have a difficulty in maintaining everything. So house is essential. Food, shelter, paying taxes, these are essential. You have to deal with them. Car payment. I was talking to car today, and just to find out, because when you are talking to viewers who want to make sure, I was asked them, I say, I have a MB and this is my payment and I want to know what you have to do. He said, okay, we can give you 3 months deferral program. I said, don't do it. I just want to know. So they said, we'll do it, but a year from today, you have to pay them in a loss installment. You have to pay all of them again. Okay. And I said, okay, that is not a problem. I said, what about the reporting to credit bureau? He said, no, you have to deal with that. We defer to you, you deal with that. So I said, okay, don't touch it. Because we don't want to show deferral payment for everything that you do, house or mortgages and all that stuff. So I'm just sharing with my viewers because this is how you need to find out. Because when your credit report is affected, then really you lose a lot in terms of doing business or borrowing a loan for essential things that you have to have. So it's very, very important that we remain prudent. Getting back to it, there are two things coming to my mind. One is a conventional mortgage that we know that those people should be okay if they have a line of credit. The other one is the high-risk mortgages, CMHC. People,
High ratio.
yeah, loan to value ratio. People think the CMHC, once you have a mortgage with them and they are insured, it's a guarantee that if I go into default, nothing will happen. That is not true, to my knowledge, because they are insuring the bank. The bank gets the money from the CMHC, but CMHC has to come after you, and following the same procedure Mr. Qureshi has explained. And not only they're going to recover their cost and penalty and all that stuff, you will be in the same predicament. So, Mr. Taimoor, do you have any deal that happened with the CMHC that you have done, or something you can share with us that going to CMHC does insurance, even though they charge you lots of money nowadays, it still cannot protect you from default payment?
Definitely, no, Tahir, you're right on the ball there. Definitely not. Okay, and more in that case, it's more fees are definitely added on because now CMHC has to recover their losses because they're liable to the lender for the amount that they've insured. One key factor for borrowers that has come to light through this is that a lot of default fees are being challenged, especially now, and we see on a lot of high risk mortgages that there's a lot of pre-default fees already in the term. Some of the borrowers have no knowledge of because when they're signing, they're at the time of buying or refinance, they're signing their life away and they're not kind of going through each document. There's like 50 pages worth of document that they're signing,
yes,
and they have no knowledge. Sometimes they do have knowledge. When I'm signing up a borrower, I take them through the entire document and say, look, these are the fees that are in your commitment. If you default, this is what CMHC will cover, but this is what they reserve the right to come after you for. And they're like, okay, that's okay. I'm aware of it. I signed it. Now we come to the default time, and those are the fees that the lenders or CMHC will come and ask for. What's protecting the borrowers are Section 8 of the Interest Act, which says some of these default fees cannot be charged unless the lender or CMHC can show proof of actual loss incurred. So if, for example, a mortgage commitment said on default, $1,500 automatic fee goes to the lender for default, that is actually not legal per Section 8 of the Interest Act and an Ontario Ontario Court of Appeal case from 2016, which is establishing law. You have to actually show proof of admin losses or NSF losses that the lender had actually incurred in order to claim those on a power of sale or default proceedings. So that is something that's kind of come back to light recently that's protecting a lot of people that are defaulting. But to go back to their initial question, it's people have a misunderstanding of the CMHC coverage that they have.
Okay, I'm going to go back to Wes. Wes, when we do the mortgages, there is an insurance. Some people opt out, and some people do get the mortgage insurance, which is about 1% of that. And it talks about that if you are not able to pay mortgage, something happens. Can you elaborate a little bit about that? Is it has to do with a loss of job or income loss, or is it to give a cushion to people if they are in default, or they're going to go into default and they can exercise that right when they are getting the mortgage and get that insurance?
Creditor disability insurance would protect a borrower who was unable to work at their job for payments of up to 2 years. And when the policy is written, every lender might have a different creditor insurance package. I can only really speak to the one that we offer our clients. And I had a client who injured himself playing baseball.
Okay.
Was unable to work at his labor, like maintenance type job, for a period of actually indefinitely. So, but his company allowed him to work in the office. So because he was unable to return to the job that he had when he took the insurance, the creditor disability insurance covered him for 2 years of mortgage payments.
Wow.
So that's a good story about that. It doesn't have anything to do with workers' compensation or anything like that. It's if you sustain an injury and are unable to return to the job that you had, they will pay.
Yeah, but is it not something to do with unemployment? Let's say somebody lose the job, it doesn't cover that.
No. There's no coverage for getting laid off. The only thing that you can do proactively is A, if you have your safety net that we discussed.
Yeah.
B, if you do not have a safety net, be proactive with your lender. Talk to them about deferring payments. Deferring payments is the big hype in the news today, but this is something that has happened over history. Most lenders, if you are proactive and you call them, they will work something out for you while you sell your home to remedy it or find another job. They're not going to wait 6 months for you, but if you proactively, you show them, I can't make my payments anymore, I have got my realtor, it's listed, they will work with you in those situations.
Oh, that's very good, because so basically you are saying is that if there is no job, if you lose a job, even though you have insurance, you've been paying premium for the rainy day, it will not help you in this case if you lose a job. So the insurance only in case you get injured, correct? That's what
the creditor disability insurance, correct?
Creditor disability insurance.
If I can jump, I think there's also loss of life insurance in certain cases too, correct, Wes?
Yeah.
I thought there was some insurance where if you lose a job, I think I remember when I had the first mortgage, RBC was saying is that if you lose a job, you can make your payment, we'll make payment for you. There was a program, I don't know whether it exists now or not. That was over 20 years ago. But that's one point.
Now, not that I'm aware of today.
The things have changed, things have changed. So the most important thing that we have to consider in this is that, first of all, viewers, make sure that you do due diligence, you focus on what you're doing, where your standing is financially. You are the first person to know whether you're going to get in financial trouble to make your payment or not, because either you have extended yourself too long to the time that you have thin your ability to pay all the bills we have. We have student loans, we have kids' education loans, we have a car payment, we have car insurance, home insurance, mortgage payment, food, clothes, gas. They're all expenses. So important thing is to make sure you create your monthly budget and make sure you stay within that budget to make sure those essential elements, something you can control, you stop not making a trip to overseas or going to Disney World. You can cut those down, but essential thing you can cut down. You need a house to live there, and rental is very high. I was looking at 2-bedroom apartment in Toronto is about $2,700. Two-bedroom apartment, 700 square feet.
That's a good deal. It's probably higher than that.
Yeah. So imagine that. So if you own a house, this is a good thing. This is a blessing, because you have a house that is appreciating. Plus you are paying a mortgage. 40% of your payment includes your principal. Plus it's going to appreciate sooner or later. If you have one house, you don't have to worry about the turmoil. It goes through it, but make sure you make your payment. Now,
I think it's important to note to hear that it's not just payments being missed that can put your mortgage in contract in default.
yeah,
It's not just missed payments. Like
No.
yeah, maybe Taimoor could speak to a
Um,
little bit of the other things that the borrower is required to do.
yeah. So Tahir, when's the break coming up? I don't want to get cut off.
yes, okay. Yeah, so we're going to be breaking in 2 minutes, 7:25, 2 minutes. In the meantime, I think we will talk about just a conversation, then we'll go back about the power of sales, and also the creditor could be sued because because of the damages in order for the lenders to make effort to collect their money. And sometimes the value of the property has depreciated, so whatever the value was is not the same, and you will be on the hook for that difference if the lender is, you owe money, and
Yes.
obviously the bank has to do that. So we're going to allow the television to go ahead with a 1 minute break, and then we will continue our conversation. So Ayman, you go ahead. All right, we are back after the break. You are on Awaz Television, Mortgage Coffee Talk with my guest, Taimoor Qureshi and Wes Sudsbury. We were talking about consequences of mortgage default. Now, issue I have one is when there is a no, when the buyer is not able to arrange alternate financing, even though there are brokers like Wes who can arrange very creative financing to get you out of the trouble. Losing a house or going on a default means you are losing whatever equity you have in the house. You should make effort to make sure that you don't get into that trouble. Sometimes you may find a friend or family member, they might be able to join you, co-sign something and help you to get refinancing done. But don't lose your equity, because that's the only asset normally or financial position that you have created for a long time. And you don't want to lose your saving. And biggest saving that we have is the home equity. Now, if a power of sale is done, let's assume unfortunately that things went out of control and we are not able to arrange financing, nobody's there to help, everybody in the same boat because of coronavirus, and they have to sell. So idea is that, like you mentioned before, that a seller will try to sell his house before it reached that point, which is very prudent to sell the house, like Wes said, sell the house and take your money, and then you can buy the house again. But if you cannot do that, and if you cannot talk to your friends, if somebody will take your house and refinance, if it's not happening, then basically you have one right, a redemption right, and you continue to let the bank sell the house. Maybe you can provide us a clarity. When a house is sold, at that time you lose the right of redemption. Is it or is it the time of closing you lose the right of redemption as a creditor?
So the borrower has up until the day of closing, even actually on the day of closing. So let's say now the power of sale redemption time period has expired, right?
Yeah.
The bank has taken possession after to rid of possession. They have listed the property, gotten at fair market value, got an offer, sign an agreement of purchase and sale with the buyer. May 30th is the closing date. Okay.
Yeah.
The the borrower has up until the registration to make good on the payment.
Also, that means they can claim the redemption before the transfer of the ownership.
Before the transfer of ownership, as long as it's up to the dollar amount, interest, legal fees, all expenses incurred by the lender at that point, right? If they have paid that back up to the cent, then the agreement with the new buyer through power of sale is null and void, and that's a standard clause in a power of sale agreement of purchase and sale.
So that means that when people are signing the mortgage list, when they're buying a house and they're signing the mortgage document with a lawyer, when they're buying the property, they should read these clauses. They are there, correct?
Yes. So sorry, are you asking about from the perspective of the new buyer who's buying?
Yeah, I'm talking about new buyer, for example. Yes. Who later on come into the situation.
Yeah. So the buyer who's buying the property from the bank, right? 99% of the time, it's very rare that I've come across an agreement of purchase sale where this clause is not in there. And if it's not, then by law, the existing owner is protected by law anyways. But this clause is usually in the agreement of purchase and sale, where it says the lender through selling through power of sale has the right to back out of the agreement if the original owner makes good on their payment up until the transfer of property.
Yeah, now, Wes, when we have this power of sale agreement of purchase and sale, and I am, as you know, I'm a broker record for City Pro Realty Inc. brokerage. And there's a lawyer firm, Gowling, I believe, that they cross so many clauses in there. The bank doesn't take no responsibility. Everything is sold as it is. We don't even know the furnace is it leased or is owned or air conditioned or appliances. We don't know what the condition is. And they don't allow the inspection. If they want to do inspection, you do it yourself. So basically, you are taking a risk when you're buying a power of sale properties, correct? In this situation, how a person who is buying a power of sale property comes to you as a mortgage broker, what do you look at them when you are helping a new buyer to buy something which is on a power of sale?
Well, I think any mortgage application requires due diligence. Buying a power sale property would be no different than buying any property. You have to do your own due diligence. The lender is going to do, the new mortgage lender, if you're buying with mortgage money, is going to do their due diligence. There could be appraisals required. If the property is in disrepair, the new lender may require an inspection anyway. And after review of the appraisal and the inspection, they can choose to forego financing. So you have to do your own due diligence, and you also have to be prepared to pay higher rates if you have to close not with a non-traditional lender. So if you don't have a financing condition in there to protect yourself, you can open yourself up to some serious risk.
Yeah, okay. Now, question I have for you is, Taimoor, is what kind of cost that a borrower going to incur to seek your services to try to help you negotiate the deal? Do you get involved with that? Helping with the lender to solve the problem with the borrower and this? Do you get involved? Or
no, that more so when they come to if they're in default and by law the lender is in the right, then what we do is, so you touched on it a little bit already, is they will come to us. It won't be for them to get their mortgage back in good standing. What we will do is, if they're coming to us to sell their property, then we can negotiate with the lender or their lawyer, right? And sometimes I'm on the other side of it where I'm acting for the lender and it's the borrower's lawyer negotiating with me to say, yes, we know your client has the right to the property now. They served the proper notice of sale. The redemption time period has passed. But our client has listed the property back up on the market themselves. So would you please consider holding off on taking possession of the property and sell it yourself? 99% of the, well, I wouldn't say 99% of the time, but most of the times, the lender would listen, merely because when a person is listing the property on their own, right, they have the opportunity to take bidding, alternate bids. The lender, when they are selling under power of sale, as long as they've listed the property at fair market value, they will take the first offer that come in. They won't wait for a bidding war. So
because they want their money back.
They want their money back as soon as possible, right? So as long as so this might come up in another question, so feel free to stop me. But it all depends on which, like if there's multiple lenders, first of all, right? You have to know which lender it is that's taking the power of sale action. Because as long as the borrower is in good standing with their first mortgage, right? The first lender won't care. It's usually a second lender or a third lender that hasn't been paid who's initiating the power of sale action. So in that case, the second lender has to make sure that they list it at a price where not only will they be getting their money out, but they have to pay the lender that's in priority ahead of them out as well. So that all kind of goes into consideration when these things come up.
Now, second question I have for you. Let's assume that you are okay with a prime lender, which is your priority number one, which is
Right.
a prime priority number one. Let's assume that you borrow big money to maintain yourself up to date with the prime lender, but you borrow money for something that you're not able to pay, can a second lender who gave you money or mortgage or lending money, can he trigger the default mortgage default if he has a second mortgage on it?
The second lender can initiate the power of sale procedure. Any lender can initiate power of sale procedure. They have to give notice. So you have to give notice to anyone who has a registered interest in the property. So if they're initiating the power of sale procedure, they would have to give notice to the owner, of course, and then anyone who's in priority above them. If the borrower is not able to make payments on the first mortgage as well, right, and it's the second lender who's initiating the power of sale, the second lender has to keep the first lender in good position to be in control of the power of sale. So let's say, just in this hypothetical scenario, RBC is the first lender, okay? The borrower was okay with RBC. There's a private lender now in second position who's not in good position, who's not being kept up to date. The second lender initiates the power of sale. While the power of sale procedure is ongoing, the borrower is now falling behind on RBC's payments as well. In order to still remain in control of the power of sale, the second lender has to make payments on behalf of the borrower to RBC. And any payments that they make on behalf of the borrower, they can charge the interest rate for their mortgage.
Okay, fantastic. Now, Wes, do you see someone coming to you that they saying that they need to borrow money very privately to pay the mortgages, and we know that I have money coming to me in a few months and I will take care of it? Do they have a situation where that somebody comes to you under these circumstances to borrow some money and have a second mortgage on registered?
Yeah, we've seen that. I mean, it's not every day that you see that, but you do get calls, and we do have solutions as long as it makes sense. No lender's going to want to go in a second position to remedy a default situation without reasonability that the borrower is going to be able to remedy their own situation. So maybe somebody has a lot of equity in their house, they've lost their job, they missed a payment. They may come to us and we can link them up with a realtor and a second lender. The second lender can either maintain that first mortgage or float them some money so that first mortgage stays up to date, and the property gets fixed, listed, and sold.
So now let's assume this is a worst scenario. It's a nightmare for someone to not to pay a government default, lose credibility. If you're damaged, your credibility, that's the worst thing you want to do. And if you want to have a house and a shelter on for your family, so idea is to use qualified professionals, seek guidance, and pre-plan proactively. You like said, Wes said, proactively prepare yourself and not to ignore signs where you feel that you might end up with a default, and to avoid all the loss of money and equity or saving. It's not a good idea. It doesn't look like a good idea based on our conversation today. So now let's assume that somebody get defaults and intentionally or whatever reason, then you end up going to the power of sale and you don't get any money. You thought that there was equity in the property, that you could get some money, but all expenses are eaten up by lawyer's fee, administrative fees of the banks, and paying the realtors. Sometimes they give discounted prices, but the power of sale, everybody charge full amount. And this is the impression we have in the public, that everybody charge full amount and poor guy, borrower don't get any money. In fact, they get sued. So there is a potential when the lender is not able to recover all its borrowed money. And obviously now borrowed money, and there is on top of that is all the expenses, legal expenses on top of that. So how often do you see that the bank is going after the person who has defaulted on mortgage payment, because their credibility, their investment, everything is kind of ruined for 6-7 years down the line. So Taimoor, what kind of protection they have, if they have any, or they are at the mercy of the borrower, the lender?
No, they're at the mercy of the lender. So I'll give a detailed answer, but yes, too long story short, yes, they are at the mercy of the lender, unfortunately. So let's say on a power of sale procedure, if there's any excess funds left over after the sale, those come back to the borrower. If there's after the power of sale, if the lender hasn't recouped their losses, they still reserve the right to come after the borrower for any leftover money. Now they can initiate an action. If the borrower is still employed, right? They can go take court action and try and garnish wages. That's one way to recover losses.
So this has a consequences.
It's not a good situation to be in. Definitely not. Yeah. Right? Just because now it all depends. Like it's a case by case cases for the lender to assess too, to see is it worth for us to spend even more money on this to chase this person, when like that's a case by case scenario. They'll know the personal circumstances to see, are we going to be able to get anything more than what we've gotten back, or should we just cut our losses with what we've recouped?
Yeah, this is where I have advised my clients and discussions with the people that if you are in a situation that you think that foreseeable, that in few months down the line you're going to be in trouble, you make a decision now. You may take some losses, maybe get some less money, but you save your not only money, but also your credibility. Because as you mentioned, Wes, it affects the credit report, and credit worthiness is important in this day and age, and this is our business. If you want to buy anything, you want to do anything, you have to have a credibility. So it will affect you. So basically, it's a very, very alarming situation where people have not taken seriously. I am sure with this coronavirus impact, we're rethinking about our way of life. We're thinking about our strategy. We're looking about how we cope with the new challenges, generate more revenue, and deal with the complex issue we have. Defaults on mortgage payment or any payment. Now, question I have for you is that if somebody borrowed money and put a lien on the property, what will happen in that case? In case there is a default on, what is the priority that the person they will get it if they are one of those, the lender who gave the money to borrow something. Sometimes we have a construction liens like that. So any effect on that? What is the priority? The taxes is number one priority, isn't it?
Number one priority is CRA. Okay,
Yeah.
they come after everyone. CRA is called the super lien, but they're normally so we've had cases like this. They're normally pretty good to work with. They will, if somebody's selling the property, right, and the lien, their lien won't allow, basically is putting the deal in negative. They're actually pretty, people have like this bad image of CRA. They actually work with you. So let's say, after selling everything, CRA is owed $200,000, right? And the borrower, because of that, is in the negative. CRA will in most cases reduce what they're owed by that amount, so that at least the borrower is not paying out of pocket. So CRA is number one. But that's just, a tidbit for everyone to know that CRA in these scenarios are actually sometimes very nice. So it's it came as a surprise to me too, and a couple of times when I've dealt with them last few months. After that, it's if it's registered on the property, then it's the property taxes, right? If there's a lien registered, then it's the property taxes. Then it goes the lenders in priority. If it's a construction mortgage and a construction lien has been registered prior to the mortgage, then obviously that takes effect too. So that's why most lenders, when they know that they're lending for a construction mortgage, they do a holdback of certain portions from the mortgage.
10% no stop.
10%, 15%, right, depending on the project, to cover themselves for that scenario, so that they maintain their priority.
Yeah. All right. We got one more question. Is when we are in a situation that, let's assume a borrower owe money now, and power of sale did not generate enough revenue, depreciation of the property because of coronavirus, and the guy owe money. Now we have a hit on the credibility, and the borrower had no choice. He may be forced to go declare bankruptcy. Is that Vas? I'm going to go before I go to Taimoor. This is a final comment on this. Do you feel some people have been told that this is what's going to be the possibility if you go into this route and not be responsible paying your mortgage?
There could be there are a number of things you could do. I mean, you can do a proposal. You could take out a new loan to pay off the judgment that was put against you, or you could just let them garnish your wages for whatever the judgment provided them with for the foreseeable future. But the creditor is going to get paid, and if you do file bankruptcy, the trustee is going to look at everything. So you better be prepared if you have any investments outside of that mortgage to declare them, or outside of your real estate. I meant, not the mortgage. The trustee will do their due diligence before they're writing creditors off in a bankruptcy and discharging it.
Okay, Taimoor, you got 1 minute to say. We're getting close to our program, so final advice to my viewers, and then leave your name and number, and so they can contact you in case they need any help.
Yeah, one key item I want to mention, and Wes touched on this just before we went to the break, is right now most people are talking about default just for missing payments. There are a lot of other things that the lender can note you in default for, and those are all terms in pretty much all mortgages when you sign them. If you fall behind on property tax payments, if you fall behind on utility payments, if you fall behind on your condo payments, right? And any of those, if you are not up to date with your home insurance, fire insurance, those are all actions for the lender to note you in default as well if they choose to do so. So just please be aware of that as well. But on a final note, I will say, Wes mentioned the key word for this meeting is be proactive. Please get ahead of the situation. Do not wait until you are missing payments to take action. To wrap this up, I can be reached at my email, tqureshi@kormans.ca, tqureshi@corbins.ca, or you can call me at 905-270-6660, extension 222. Tahir, thank you for hosting us here today.
You're most welcome. Wes, you want a final thought before?
Yeah, final thought, as Taimoor mentioned, it's important to be proactive if you anticipate any change in your ability to keep your mortgage contract in good standing. If you do anticipate problems, speak to professionals. There may be solutions that out there available for you that you're not thinking about, that you have not yet learned. Speak to your lender, speak to your mortgage broker. We may have ways. Speak to your real estate agent if you think that it's your last resort. If you are in a situation where you think you are going to be unable for the foreseeable future to make any payments, take control of the sale of your own house. You can. A new day will come. Get your equity out and move on before it's out of your hands. If you do find yourself in trouble, or if you just want a look at your mortgage, feel free to reach out. My name's Wes Sudsbury with Home Guard Funding in Newmarket. I can be reached on my cell 416-995-3391, or by email wes@homeguardfunding.com. Or you can visit our website, homeguardfunding.ca.
Thank you very much, Wes and Taimoor, for your time. Viewers, you have learned today what really happens if you default on your mortgage payment. So it's very, very important for you to be proactive. This is the advice of our guest panel. Be proactive. You know where you stand, and do not extend yourself. Have some funds available for rainy days. Coronavirus has affected really everyone in Canada, across Canada, and lots of people have lost their job, and they're going defer payments. Deferred payment is very different than default payment. Default payment is that you're breaching a contract that you signed with a lender when you borrow the money. And there are fine line when you are buying a property and signing a loan agreement. Make sure that you go through line by line every content of the agreement that you sign with the assistance of your lawyer, so you understand the consequences of default mortgage. I take this opportunity to thank every one of you for joining us, watching Mortgage Coffee Talk on Watch Television in Canada, around the globe, and also on Facebook and YouTube channel. I also take this opportunity to thank our health workers, doctors, engineers, scientists, health nurses, police officer, first aid, all those who put their life online to protect us and provide service and take care of our elderly people and risk their life to save our life. We thank you. We salute you. We thank you very much for your service to Canadian. God bless you all. Thank you for joining. God bless Canada. Thank you. Good night. Bye for now.
Thank you.
Right.